Hi everyone. Can you hear that's good? Looks like it. So great to be here, and I just thought we'd start off by if you guys could introduce yourselves before we start talking about hyperlocal.
Sure. So my name's Tige Savage. I manage a venture capital fund called Revolution Ventures. We started about 10 years ago with Steve Case called Revolution. We now manage sort of two investing efforts with similar theses but different stages. One's our growth fund, which is a little later, and then the ventures fund, which is essentially Series A investments. Again, that's what I'm involved in. And our sweet spot is sort of big existing categories where money's being spent and technology has not yet changed the rules of the game. We love to invest in companies that have the opportunity to sort of change the rules of the game in those big categories.
Is this on? Okay, great. Hey guys, my name is David Ambrose. I'm the managing director of an early stage venture fund here in New York City called Steadfast Venture Capital. We haven't been operational as long as Tige's fund. We've been doing this for less than a year, and we're learning a lot along the way. We tend to invest in four types of categories of businesses. Travel is a very big one. I spent the last 2.5 years at a public company called TravelZoo. And then before that, I spent 4 years building a company in the local deal space where I lost most of my hair. So I can talk about all the pain points back during that economy. So we also look at local quite a bit. E-commerce is another big area that we get excited about. And then it was fun for the last panel that we did, which was on email. We love digital media businesses. Seed and Series A is our sweet spot. And we tend to look at a lot here in New York City since that's where we're based.
And I'm Dominic Rushe, and I'm the East Coast tech editor for The Guardian. So I just thought, it seems like a really interesting moment in local at the moment with the rise of the sharing economy. Everyone's talking about Airbnb and Uber, and I swear that when I was in San Francisco, I heard somebody talking about a company they said was going to be Uber for dog sitting. So everyone seems to be into the sharing economy at the moment. Is this your experience as well? Do you think?
Yeah, so we invested against what I guess is now called the sharing economy concept pretty early, with originally a company called Exclusive Resorts, which was sort of a high-end rich people's club to share vacation houses. And then in an effort to find something that was more accessible, we backed a company that ultimately became Zipcar. And if you think about it, this is now, I don't know, 8 years ago. They were really the first generation, very asset-intensive businesses, leveraging technology to do things that you couldn't share in a meaningful way. You know, people had wanted to share cars for a long time. It had been this utopian hippie dream run by, like, utopian hippies. And eventually, you know, technology and professional managers got involved. That became Zipcars of the world, and similar thing at Exclusive Resorts. But they, you know, the balance sheets of those companies supported the assets for those businesses. So Zipcar owned a bunch of cars and ultimately got public and got acquired by Avis. A big piece of the reason that strategically made sense is they had to buy a bunch of cars. They needed access to the capital markets and debt, et cetera. The same is true with the sort of Exclusive Resorts model. Juxtapose that against what has now happened today, where consumers are much more accepting of this. It's much more ingrained in the way that people think. And that enables these asset-light models, which I think, frankly, are better business models, to flourish. So Airbnb is, in some regards, sort of the next generation of what that Exclusive Resorts concept was, but much more accessible. And they don't need to buy apartments in every city in the world because people already own those apartments. It's enabled by technology. And then Uber is, in some regards, sort of the next generation, actually the generation after the next generation of what Zip started. So I think there's been a lot of progress there, and I think there's a long way to go, but the concept of using technology to essentially enable the smart utilization of assets, which is what the sharing economy concept is, has a lot of legs. It's real.
So, I mean, we talked about this earlier, but it's very interesting the way these companies are platforms, really, rather than they don't own the direct relationship with the local businesses in the way that, say, I'm sure we'll talk about it in a minute, but Living Social or Groupon have direct relationships. I mean, do you see that as a growing trend?
Well, I mean, that's the one area that I think we're thinking through, which is we've always had this view that owning supply in the case of a small business is quite attractive, right? So being able to have a direct relationship with a small retailer or a laundromat or a restaurant is quite important. And I think when you look at the sharing economy, in a way we look at it, it's really a 1099 contract worker. A lot of these businesses are built where they don't have supply relationships. They're using effectively logistics services to route inventory quite smartly. So in a way, they're actually hacking supply by funneling demand as aggressively as they can, really through mobile. And if you look at 2007, when we were building a company called Scoop Street, most of it was done through email. And you have this perspective too, Tige, probably through Living Social's early days. Most of the business was through push. And you start to see now these companies are coming out where you can actually do more pull on mobile. So the asset-light model of the sharing economy is interesting. The next question becomes is, can you build businesses on top of it? So there's a company, and a few companies in the case of the vacation rental space, where they're trying to bring yield optimization and dynamic pricing, and that's completely built off of the sharing economy. I think we'll start seeing that more with 1099 contract workers, where you have a unique identity. All of your past worker history potentially is on Uber as a driver, and then all of a sudden you end up routing. Hello. Oh, thanks, Tige. The question then becomes is, do you end up routing your worker history from, say, a platform like Uber, and can you go to Lyft? Can you go to Sidecar? So we've been thinking about that quite a bit, specifically for the most important assets of the sharing economy, which is actually the people, the 1099 contract workers. So in a way, you're almost thinking about a generation or a generation after, like we're talking about with Uber. But the one thing that I think, and I'd love to talk about this later, is what's more important, owning supply or funneling as much demand as you can?
Yeah, I mean, I think that's just a really interesting question. I mean, is it less sticky as a business if you don't own that relationship? I know those relationships, especially with small businesses, are very labor-intensive and difficult to maintain and indeed to establish in the first place. But if you're just providing the platform, what's to stop these people moving on to whatever the next platform for them is? If there's a rival to Airbnb that somehow does it better, is scale all that matters in these businesses?
I mean, what would you say about this? Because I think the way that we've seen it is, if you can generate more orders or butts and seats for the small business, that's the lifeline of revenue.
So
but you may not have a direct relationship with the merchant.
I mean, this is like the magic question, and certainly the companies that solve both, magic happens, right? You got supply and you got demand. That's a network, and like the first huge example of that was eBay, and amazing things happen. I think today you actually don't need to win both sides of the equation. We had a panel earlier that was talking about sort of commerce, and CEO of one of the companies we're invested in called Booker was asked a similar question. Booker is essentially a platform that it's kind of an operating system for services businesses. And they have intentionally not gone after the consumer side of it. Our growth funds invested in a company called Handy. It was Handybook. And they've gone after the consumer side of it. And those are, on the surface, very similar. Both companies have the opportunity to be successful. Booker's approach, essentially, is there are lots of companies out there who are aggregating consumers. And those companies look like Yelp and Groupon and Living Social. And they actually have inventory problems. They need things to present to those consumers so they can monetize in ways that either amplify the things that they've traditionally sold or are complements to it. And the Bookers of the world, and there's a lot of companies like that, they're solving the inventory problem. I actually don't think that it is easy for companies, to your question, to transition away from those platforms, because if the platforms are built correctly, they're doing a lot more than just aggregating content. They are helping them run their business. They are helping them be smart about their business. There's no reason today that a small business can't have the kinds of tools that large businesses typically, that were reserved historically for large businesses. If you're providing those, I think those platforms become pretty sticky, and you can matter to one side of the equation and partner with the other side of the equation in terms of either being supply or demand.
So, and where do you think is going next? When you mentioned services, then is that you think the sharing economy goes more into business-to-business services?
I mean, it's a good question. So there's a lot of similarities between travel and local across the spectrum, and So I'll just talk a few examples right from the days at TravelZoo. TravelZoo was a business that would basically inspire folks to get off their seats, off these couches, to go to a new destination. And that first started with media. And then on top of that, then they moved down. They realized that once you get in a destination, you can start doing local products and services. So they started with Broadway shows. Then in 2010, they went into the local economy. And I think what we ended up finding about in that category was that it's very labor intensive to go out and acquire the customers. And one of the key tenets became is, if you win in local, it's about being cheaper, faster, and more efficient at acquiring your customer base, generally small merchants. But the one thing that's been really interesting to see, particularly for the sharing economy businesses and companies in our portfolio, is that they're using technology to drive down the cost of what effectively CAC is, the cost of customer acquisition. And in a way, we're seeing it for a few businesses. Probably the best example of it, and a lot of people don't necessarily think about it, is Hotel Tonight. Hotel Tonight built a business where it's extremely difficult to acquire a hotel. In a way, a hotel is probably an advanced small business where they have budgets and they actually have folks in the companies which are revenue managers, so they're incented to do digital distribution. Hotel Tonight effectively built a remote control on the phone for revenue managers to load up inventory. So we look at a lot of business intelligence, B2B backend enablers that we look at for these companies, and we get really excited about that, where that tends to be, you have to be patient in building, a bit more defensible, and also we start seeing that you can actually charge upfront with a revenue very quickly, then hoping to figure out a revenue model there. That's the immediate. Where is it going to next? I mean, we're looking at lots of companies now that we really think about when you look at, again, Airbnbs, vacation rental owners, smart CRM. I think Drew was up here earlier from Shopkick. We talked last night, but the advent of the receipt, of a digital receipt, of understanding who your customers are through smart CRM, and Stu was here from Signpost, that's really incredible stuff, right? So I think the value is being able to give control and power back to the merchant to remarket to them. That's been a vision that we've seen for quite some time. I remember living the experience of going door to door and talking to merchants. So
Tige, you live in Washington, and I read recently a piece from Ron Klein, your partner, about the regulatory issues that are coming up with the sharing economy now. And in fact, I think he said in the piece that in a way Uber, etc., were not disrupting technology, but disrupting regulation. I mean, do you see that as a handicap going forward, especially if we're going to move into different areas, job supply, etc., and other highly regulated areas? Do you think we could see some more regulatory clashes here?
Yes. So, as we think about it, there's been sort of stages of companies built around the internet. The first was the Googles and the Yahoos of the world, basically getting people online and tools to do that. And then the next was things that enable applications online, enabled you to do things online, Amazons of the world, et cetera. If you look at the companies that are growing today, it's kind of the next generation. They're letting you do things offline, right? So the internet is an enabler. Those are big categories. And if you think about the categories that were transformed in that second generation, Facebook, Twitter, Amazon, those are some of the sort of least regulated. It's sharing and it's buying stuff. Those are pretty unregulated. If you look at the companies that are being successful in this next generation, it's transportation, hospitality, education, healthcare, like the most regulated categories that are out there. If you're interested in this intersection of sort of technology and policy, one thing that I'm pretty sure of is the next 10 years are going to look a lot different than the last 10 years. It was very sort of Silicon Valley vogue to ignore DC and be very sort of out. The largest hirers of lobbying talent are the big internet tech companies. They can't hire fast enough, and because they're realizing that whether you like it or not, some of your biggest customer and largest regulator is the government, and if you don't interface with it, you're going to miss out. So now we're biased. We're from Washington, and we're sort of inside that world, and we've got some access to it. But I think the big companies that are created in this generation, there will not be big companies that are created in this generation that don't have very serious, sophisticated approaches to the policy aspect.
Right, because we're seeing that at the local level, aren't we? with Uber, say, in different cities, the taxi regulations, and we're going to see that again and again, not just at the federal level, but at the state level as well.
Yeah, so, I mean, let's just talk about the companies that we've mentioned. So Airbnb is dealing with, like, the most local, condo associations, not even regulatory, just dealing with rules, plus all the local regulatory stuff, plus the federal regulatory stuff. Everybody knows the stories about Uber and fighting the fights in the localities and letting the consumers win, but ultimately they go in and negotiate with the regulatory folks. They just try to get leverage. It's, you know, the biggest analogy, I think, goes back 40 years, and that article you mentioned makes reference to it. The last time there was a big transformation, sort of business hits regulation, was about 40 years ago. And it was in the transportation and shipping categories. And they deregulated trucking, they deregulated the airlines, and, you know, the outcome of that is companies like FedEx, which couldn't have existed, now exist. UPS couldn't have existed, now exists. Airlines, I mean, in real costs, like inflation adjusted, it costs 75% less to travel today by airline than it did prior to the regulatory changes. But it was a different world 40 years ago, and I think policy makers are going to have to sort of address it, because it's very cross-aisle. You know, the Silicon Valley's got very sort of Democrat-leaning things, but it's the anti-regulatory stuff on the Republican side of the aisle, so I think there's going to be some interesting alliances that come about, driven largely by consumer demand, enabled by technology.
Yeah. I mean, one of the interesting things is the fact that this time around, companies have been prepared to break the law and then hope the law catches up with them, haven't they? Which I guess was different when they deregulated transportation 40 years ago. I imagine it was a very different time. But none of these things, though, seem to have dampened the investor enthusiasm for these companies. They're obviously assuming that these rules are going to be fixed in the end to allow people to use these services. I mean, I just wonder, I mean, everybody talks about a bubble now and about, you know, valuations being insane. So, I mean, do you feel we're at the peak?
So when we did Scoop Street, we raised in 2008, and we raised $1.2 million on maybe it was like a $3 or $4 million convertible note, and that had some revenue, right, associated with it. I think today you're seeing companies at the seed stage where they're trying to figure out product market fit, $7, $8, $9, or $10 million, depending upon certain programs they're coming out of for accelerator programs. Now, I think the issue with it largely comes down to expectations for the next group of investors that come involved, and more so the entrepreneurs that are there. And it's really tough to educate, especially a first-time entrepreneur, what that means specifically in the cap table, as we were talking about earlier. I don't know if there's a bubble. I think one of the things that we think about a lot is course correction in the public markets, and then when it catches up on the private side. So we've reached out to some of the folks in the portfolio, and I shared my story as to when we tried to raise in Sand Hill Road in Silicon Valley, and it was terrible. We couldn't raise any money for a year. And it was early 2009, Sequoia Capital came out with this amazing pitch deck, or this deck that they shared with their portfolio called RIP, Good Times. And it was a picture of a tombstone, and that's when everything collapsed. So there's two ways to think about it. Either you're very opportunistic, and I think we're kind of at the, we don't know if we're at the peak, but in the last 6 or 7 years, I mean, the markets have been good. The question becomes is, if the economy does do a downturn, right, what happens to the portfolio, right? And I think many folks in the investment community will say, okay, we're going to double or triple down on our winners, right? Because the feedback loops are so long, it's going to take 2 or 3 years to know when your companies do well, and we're just going to cut our losses for the companies that haven't performed, right? That's especially at the seed stage. Now you have growth funds that are coming out and looking at companies in the categories of, you know, what Tige was mentioning, in these on-demand services. We haven't invested in any on-demand companies because I think we're still trying to figure out is, if you have a phone, right, and Handy may be there that's going to own the home cleaning services, is there an opportunity for a second or third home cleaning services? Probably not, especially with the smartphone utilization. So the question becomes is, as we think about a lot of these categories and the valuations increasing is, as investors to our LPs, we have to think about how do we maximize the returns. So usually you can do that when you have lower valuations. If you look at historical data and empirical data, if you can get in somewhere below, you know, $4 to $5 million on seed deals, most exits happen below $50 million, $50, $75 million. You can actually generate 10x, which is what many investors tend to look at. But I don't know, I lived it, and I give cautionary tales to the portfolio. I don't know if we can all figure out what's going to happen in the next 2-3 years, I'm not sure, but there's really good tactics that I think you could improve for the portfolio and founders that are here just thinking about optimizing for revenue.
But do you have a sense that we're at the peak, or are we looking at it in the wrong way? I mean, every time there's a crash, people say this time is different. And I've heard people saying that a few times now, so which always makes me think we must be near a crash.
So I don't know if we're at a peak, and I'm not smart enough to call like peaks and valleys, but it's never different, right? I mean, things fundamentally change about businesses, but this doesn't change. I mean, this time isn't different in that regard.
Right. So when you're looking at companies now, I think one of the interesting things both of you guys have talked about is that it's not just happening in the valley anymore, is there? There's such a wide geographic spread of areas of technological innovation. I mean, I was talking to you earlier about, I was in Chattanooga recently, and I've been to see startups in Detroit. There's lots of places, and you obviously do the Rise of the Rest tour, traveling across the country looking at startup companies. I mean, is it possible now to build a good local business and get the attention of serious investors anywhere in the country?
So I think there's no doubt that the most robust, deepest environment for entrepreneurialism and the creation of companies is Silicon Valley. But it's not the only place. And it's become easier and easier for companies to build outside the traditional ecosystems. Because those ecosystems historically had talent in terms of people, and a big piece of that talent has been there, done that folks who've built a company, exited a company, understand what you go through, and build a playbook to run again. Access to capital, access to the services, have the partners there who can help you scale. Today, it's a lot easier to build a business outside those historical ecosystems. We'll talk about access to capital in a sec. But Silicon Valley has no monopoly on good ideas, and for reasons that we're all sort of very aware, it's just economically and practically much easier to start businesses with fewer people and less capital and variably costed services, et cetera. So we're big believers in that. And we literally, you mentioned it, it's sort of Steve Case has termed it the rise of the rest, and we go out and we spend a lot of time in markets. If you look at the places we've made most of our money, it's not in Silicon Valley. But that's because we are willing to get on an airplane and invest all over the place and do it. And that's the access to capital question. I think increasingly capital is available to areas outside the traditional geographies and ecosystems. And I'd predict that 10 years from now, most serious firms will have strategies that go outside of their core ecosystem. But today, there is a limit to access to capital.
Do you think there's advantages from building a business outside of the valley, or in a smaller, more suburban environment?
Yeah. I was just going to say two things to Tige's point, which I think is interesting. When we were fundraising for Scoop Street, equity crowdfunding didn't exist. So Title II of the Jobs Act and the Jobs Act didn't exist. So how many folks here have heard of the Jobs Act before? Awesome. So you start seeing this flourishing of marketplaces where companies can now publicly go out and raise money. And that's really improved capital flow, at least on the private side. The next thing that's also happening, which when you think about Silicon Valley and you think about New York City and you think about DC and Boston, they have great universities. They have great education programs. Now we're starting to see distributed education programs online, massive online open courses, things that folks can do on their laptops or on their phones. So people are getting smarter just about their information. So if you take those two things and you kind of extrapolate out, we've invested actually overseas a few times now. And when we think about overseas investing specifically for early stage companies, we start thinking about the market quite a bit. So when you look at companies, one of the areas that we've been doing a lot of work in is Southeast Asia. Southeast Asia is actually really interesting because when you look at the infrastructure that happened in China maybe 4 to 5 years ago, specifically for highways, logistics, and shipping, it's starting to get put in place now for Southeast Asia. As a percentage point, e-commerce is very low, but in terms of actually usage of phones, it's one of the highest countries and regions we've ever seen. So the entrepreneurs that we've talked with over there, and the teams and other investors that are here in the States or overseas that are looking at it, it's almost like a new internet that's getting built overnight. So the question then becomes is how do you spot those trends? How do you spot those companies that are breaking out at those inflection points? The beauty of today's investors is that there's so much downstream digital history and data that's getting pushed out through Twitter and AngelList and these equity crowdfunding platforms, and just signals that you see, right, on these different products. So I think we're going to see maybe in the next 10 years, next 5 years, to build a business anywhere is totally possible. It's happening now. In fact, there's great reading right now from venture funds that talk about the best returns, as Tige has mentioned, and they quantify it. They say that the best returns that they've ever invested in, you cannot invest in Silicon Valley. You have to invest in, what one entrepreneur told me was, you invest in the heartland of the States. You go up to Montreal, you go up to Canada, right, for the valuations that are lower.
And then when you were mentioning earlier about if you can build a good local business in a smaller local market, do you think there are some advantages? There might actually be some advantages to that.
Yeah, I think you tend to see companies from the companies that Tige mentioned, the companies that I mentioned. You tend to see businesses start in very urban city centers, and it makes a lot of sense. There's saturation, liquidity of folks. There's highly repetitive usage in the case of food delivery, in the case of home cleaning. The question then becomes is if you find those businesses in suburban areas. And what's also interesting is that you tend to see when companies have reached saturation in dense cities, they tend to go to suburban markets. Uber's a really good example of that. So the question becomes is can you find companies that are breaking out and having success in suburban markets and then bringing that back into dense cities? One company that I think is interesting is Nextdoor. Nextdoor takes the approach of it can work anywhere, and I think that's very important in local. So long as you have a product that can actually apply to a suburban market or a dense market, there's actually quite beneficiaries there. So in that case, it's always the litmus test of going into a suburban market, maybe where there's 10 or 15 restaurants, thinking about the small businesses that are there, and say, if you invest in this company, or if you're an entrepreneur building this, will it work there? And if it doesn't work there, why doesn't it work there?
Yes. So one of the things that people always go on about in the Valley, one of the key advantages is the fact that everybody knows everybody, and it's easier to get things started because you poach people from companies you know, and you all worked in another startup before that exists. But so for you guys, when you go out now and you're not looking at those kind of, it's not an old boys network or a young boys network even. What are the things that make you excited when somebody comes to you with a pitch? What are you looking for? And it's a terribly broad question, but are there things that people do that put them ahead of the pack?
So that is a broad question. Thematically, we try to be pretty consistent. It's what I talked about before, in terms of the things that we get excited about. And they are categories where billions of dollars are already being spent. Best if it's being spent in an old-fashioned way. There are lots of business processes and categories that just work the same way they have for the last 10 years or 20 years or 30 years or 40 years. We love those because they are ripe to change. Often oligopolies with slow-moving incumbents who are scared to cannibalize makes it very hard to get scale, but if you can do it, you can price yourself in an umbrella where you're sufficiently low-priced that they don't want to cannibalize their high margins, and if you can come in with a low-cost strategy, which translates to a low-price strategy, you can get some protection. You know, a company that we sold, we talked about a little bit before, called Revolution Money had sort of attacked the interchange, which is what credit cards, it's the credit card fee. And they had an approach that used essentially the internet to process for 50 or for 20 basis points what essentially the same margin in a traditional way would take 100 basis points. And we were really worried about Visa, MasterCard, American Express, and some guy made a point. He was totally right about it. It's a $60 billion business. For the incumbents to price on parity with us, they would have had to turn a $60 billion business that's high margin into a low margin $12 billion business, right? So they left us alone until we got enough scale, and it actually got acquired by American Express. So we love big things like that, and they're few and far between, but we love those. And then in terms of the people who run them, we like been there, done that, people who come out of the industry, have experience in the industry, and have a view on how they're going to change that industry. Not, here's a big industry that needs to change, but here's a big industry that needs to change, here's where I spent my time in it, and here's the weak point and how we're going to penetrate.
Yeah, I mean, the only thing I would add to that is I mean, Tige talked about the team. We look at that so much, especially at the early stage side. That's the best data point you historically have when these companies are getting built at the seed stage. In my case, what I call battle scars, right? If you've actually lived and breathed this domain before, you know the industry inside and out. We tend to find those are the best performing CEOs of companies. CEOs also that listen very well tend to outperform other CEOs that we found. So team is one of those things I remember as an entrepreneur pitching to folks like Tige and saying, you know, would you give us money? We don't ask that, but this is our story. That's the ask out of it. And a lot of the VCs say it's the team composition. You didn't really know what that was. I think for VCs, there's different metrics for team, different definitions of team. But I think what Tige mentioned, and I think this perspective of battle scars and having a domain background is really, really important.
Great, thanks. So I think we've got 5 minutes for questions if anyone's...
I think both of you mentioned 1099 contractors. Get your microphone. I think both of you mentioned 1099 contractors, and Tige, you mentioned that the next generation of big businesses are going to fight regulation, right? So when I look at things like Handy, I feel like they're able to make a margin off of 1099 contractors that by definition aren't 1099 contractors. They're employees because Handy's giving them all of their business, right? So is there going to be a thing in this on-demand economy where that has to be shaken up as well?
Yes. So it's funny, we are invested in a company. We had a board meeting last week, and this particular company is focused on a number of things, one of which is doing delivery of stuff. And we're in the process of looking for a general counsel for that business. And there's some obvious things, deal making and experience in delivery, but a major area that we want to sort of, a skill set is around labor and employment law because it's undefined, right? I mean, it's defined, but it's going to get redefined. And there's a lot of opportunity to either make a misstep or be very thoughtful. And it's all going to play out in the next couple of years for the reasons you talk about, you know, all the stuff that we see in the news about happy or unhappy Uber drivers or Lyft drivers or whatever. So we're not sure where it goes, but it's there's going to be something's going to happen on the labor front there.
I think the only thing I would add is there's a guy named Mike Dudas. He's the founder of a company called Button. Button is a loyalty business that's built for the on-demand economy. He wrote a post recently that talked about contract portability or contractor portability for the 1099 workers. I think that's going to happen, and I think the logic that he outlines in that post is actually quite astute. The question is, when does it happen, right? But I point you to that because I actually think it's quite relevant to the question.
Okay, I think we can wrap it up there. We're on time. But so thanks, Tige, thanks, Andy, thanks so much. Thanks, guys. We'll be around if you have any questions.